A woman in Ohio locked in a mortgage rate on a Tuesday morning, feeling relieved that the number finally looked reasonable after months of waiting. By Thursday afternoon, the exact same rate had shifted again, and she found herself staring at her phone, wondering if she'd just made the smartest decision of her home buying process, or the worst one. That's the strange, disorienting reality of buying a home right now. Rates aren't just high. They're moving, sometimes several times in a single week, and almost nobody explains why or what you're actually supposed to do about it. If you're anywhere near the process of buying a home, or thinking about refinancing one you already own, stay with me for the next few minutes and go ahead and subscribe, because we're going to walk through exactly what's driving these swings and what they genuinely mean for you. Here's the part that trips up a lot of people the moment they start shopping for a mortgage. A rate isn't a fixed price tag sitting on a shelf somewhere, waiting for you to walk in and buy it. It moves constantly, sometimes multiple times a day, because it isn't actually set by your bank, your real estate agent, or even the Federal Reserve directly. It's set by investors in a massive impersonal bond market that most home buyers never think about. And understanding that single fact changes almost everything about how you should approach the next few months. To understand why mortgage rates keep shifting, you have to understand what they're actually tracking. Long-term mortgage rates move in close correlation with the yield on the 10-year Treasury bond, which is essentially the interest rate the U.S. government pays to borrow money for a decade. When investors get nervous, when inflation looks like it might stick around longer than expected, or when there's uncertainty about global events, they demand a higher return to hold that bond. That higher return pushes mortgage rates up right alongside it. When investors feel calmer, when inflation data comes in better than expected, the yield tends to ease and mortgage rates often ease with it. Your mortgage rate, in other words, isn't really about you. It's a reflection of what a global pool of investors thinks is about to happen to the economy. This year has given that bond market plenty to react to. Oil prices climbed sharply after conflict broke out involving Iran earlier in the year, and higher oil prices ripple through the entire economy, raising the cost of manufacturing, shipping, and eventually the goods sitting on store shelves. That kind of pressure tends to push inflation expectations higher, and higher inflation expectations tend to push bond yields, and therefore mortgage rates, higher right along with them. It's a chain reaction that starts somewhere most home buyers never think to look, a shipping lane on the other side of the world, and ends with a bigger number on their closing disclosure. At the same time, the Federal Reserve has been sending a more complicated signal than usual. For most of this year, the Fed held its benchmark rate steady, which is the rate banks charge each other for overnight loans. Not the same thing as your mortgage rate, but closely watched because it shapes the broader direction of borrowing costs. What caught a lot of attention recently wasn't the decision to hold steady. It was that the vote wasn't unanimous. A handful of policymakers pushed for raising rates instead of holding them, a meaningful shift from the unanimous decisions earlier in the year. That kind of split matters because it tells the bond market the Fed isn't fully comfortable that inflation is under control, and when investors sense that, they price in a bit more caution, which shows up as upward pressure on the very same yields that mortgage rates track. Put all of that together, and you get exactly what's been happening in the mortgage market recently. Rates climbed toward the highest levels seen in roughly a year, with the average 30-year fixed rate moving into a range hovering right around 6.5% to just under 7%, depending on the lender, the day, and the borrower's specific financial profile. Then, just as quickly, a few encouraging developments, some tentative signs of easing tension overseas, a softer read on oil prices, would nudge that same rate back down by a meaningful chunk within a matter of days. This is precisely why that Ohio homebuyer felt like she was watching a live scoreboard instead of shopping for a mortgage. In a very real sense, she was. This is where it's worth pausing on something a lot of buyers get wrong without realizing it. A rate move of even a quarter or half a percentage point can sound small, almost irrelevant, when you first hear it. It is not small once you translate it into an actual monthly payment. Take a completely realistic example. On a $300,000 mortgage, a rate of 6.5% produces a monthly principal and interest payment of roughly $1,900. Move that same loan up to 7%, and the payment climbs to somewhere around $1,995. That's close to $100 extra a month, more than $1,100 a year, for a rate difference that might get described casually as just half a point. Over the full life of a 30-year loan, that gap in interest paid can stretch into the tens of thousands of dollars. Once you see the math laid out like that, it becomes obvious why buyers feel so much anxiety watching rates twitch up and down on a screen. They're not being dramatic. They're reacting to a genuinely significant number. That anxiety creates a very specific, very human trap, and it's one worth naming directly, because almost every buyer falls into it at some point. It's the temptation to wait for the perfect number. The thinking usually goes something like this. Rates are elevated right now, so it makes sense to hold off, keep renting, keep saving, and jump in once they drop to some more comfortable level. It's a completely reasonable instinct. It's also nearly impossible to execute well in practice because nobody, not economists, not mortgage lenders, not the Federal Reserve itself, can reliably predict exactly when rates will fall or by how much. Waiting for a specific number means betting your housing timeline on a forecast that even professionals get wrong constantly. There's a genuinely useful way to think about this instead, one that a lot of experienced lenders have started repeating more often as this rate environment has dragged on. The property you buy can be renegotiated later. The rate you lock in today cannot be permanently fixed to today's home price if you wait and prices keep climbing in your market. In other words, plenty of buyers have started leaning on a simple piece of guidance, sometimes phrased as marrying the house but dating the rate, meaning you commit to the home that fits your life now, while treating the interest rate as something you can potentially improve later on through refinancing if conditions shift in your favor. That's not a guarantee rates will drop. It's a recognition that a home price locked in during a competitive market can be just as hard to improve on later as a mortgage rate. Which brings up a question almost every current homeowner watching this is quietly asking themselves. When does refinancing actually make sense versus when is it just chasing a number that sounds better but doesn't actually help? A widely used guideline among mortgage professionals suggests that refinancing starts to make real financial sense once you can lower your rate by somewhere around 0.5 percentage point to 0.75 of a point compared to what you're currently paying. That threshold exists because refinancing isn't free. You're often looking at closing costs that can run from 2 to 5% of the loan amount, covering appraisal fees, title insurance, origination charges, and other line items that add up. If the rate improvement is too small, it can take years just to recoup those upfront costs through your lower monthly payment. And if you sell or refinance again before hitting that break-even point, you've effectively lost money on the move rather than saved it. It helps to zoom out for a second because the number that feels painful today looks very different depending on which decade you're comparing it to. Rates sitting in the 6.5% to 7% range feel brutal set against 2021, when 30-year rates briefly dipped below 3% and an entire generation of buyers got used to treating that as the new normal. But stretch the timeline back further and a 6.5% rate sits close to the long-run historical average going back to the 1970s, a period that includes stretches in the early 1980s, when rates climbed into the double digits, well above 15% in response to runaway inflation at the time. None of that makes today's rates comfortable for a buyer trying to make a monthly budget work right now. It does mean the framing matters. The last few years weren't the normal baseline everyone should expect to return to. They were closer to a historic anomaly, and understanding that helps explain why so many housing economists have stopped predicting a return to 3% rates and started talking instead about what buyers should do inside a 6 to 7% world that might stick around for a while. This is the point where a second buyer situation is worth bringing in, because rate swings don't hit every household the same way. Picture a couple in North Carolina, further along in their search than most, already under contract on a home with a closing date roughly 5 weeks out. For them, a rate that jumps 0.5 point in a single week isn't an abstract headline. It's the difference between a monthly payment they budgeted for and one that suddenly strains their finances, all while they're contractually committed to closing on a specific date. This is precisely the scenario a rate lock exists to prevent. And it's exactly why understanding these tools ahead of time, rather than learning about them for the first time mid-transaction, makes such a meaningful difference in how much control a buyer actually has over their own outcome. It isn't. The break-even calculation depends heavily on how long you plan to stay in the home. If you're planning to sell within 2 or 3 years, even a genuinely attractive rate drop might not be worth the closing costs, because you won't hold the loan long enough to recover what you spent getting it. If you're planning to stay put for a decade or longer, a smaller rate improvement can still be worth pursuing because you have far more time for the monthly savings to outweigh the upfront cost. The same rate offer can be a smart move for one homeowner and a bad one for their neighbor, purely based on how long each of them intends to stay. There's another layer to this that a lot of buyers overlook entirely in the rush to focus on the interest rate itself, and it involves the difference between a fixed-rate mortgage and an adjustable-rate mortgage, often shortened to an ARM. A fixed rate locks in the same interest rate for the entire life of the loan, so your principal and interest payment never changes, regardless of what happens in the broader economy over the next 30 years. An ARM typically starts with a lower introductory rate for a set period, often 5 or 7 years, and then adjusts periodically after that based on prevailing market conditions. In calmer rate environments, ARMs have sometimes offered a meaningfully lower starting rate than a 30-year fixed loan, which made them attractive to buyers who planned to move or refinance before the adjustable period kicked in. Right now, though, that gap has narrowed considerably, with ARM rates in the current environment landing close to and sometimes even above 30-year fixed rates. That changes the calculation. Taking on the long-term uncertainty of an adjustable rate only makes sense if you're actually being compensated for that risk with a meaningfully lower starting payment. And in a lot of cases right now, the compensation simply isn't there in the way it used to be. There's a related phenomenon happening in the background of all this that helps explain why the housing market feels so unusually tight right now. And it's worth understanding because it directly affects the buyers watching those rate headlines. A significant share of current homeowners locked in mortgage rates down in the 2, 3, and 4% range back when borrowing costs were at historic lows. For those households, selling their current home and buying a new one at today's rates would mean trading a payment they can comfortably manage for one that could be substantially higher, even on a similarly priced property. That reality has kept a lot of would-be sellers sitting still, unwilling to give up a rate they'll likely never see again, and economists have started referring to this as the lock-in effect. Fewer existing homes hit the market as a result, which keeps inventory tighter than it would otherwise be, and tighter inventory keeps upward pressure on home prices, even in a period when higher rates would normally be expected to cool demand. It's a strange, almost self-reinforcing loop, where high rates discourage some sellers just as much as they discourage some buyers, and the two effects partially cancel each other out instead of resolving the affordability problem. That lock-in effect also explains a small but growing trend worth knowing about if you're house hunting, which is the rise of assumable mortgages entering conversations that almost never used to include them. Certain loan types, most commonly FHA and VA loans, can sometimes be transferred from a seller to a buyer, along with the original interest rate still attached, rather than requiring the buyer to originate a brand new loan at current rates. If a seller happens to be sitting on one of those ultra-low rates from a few years back and their loan is assumable, a buyer who qualifies can, in some cases, essentially step into that same low rate instead of accepting whatever the market is offering today. It's not common, it doesn't apply to every loan type, and it requires the buyer to qualify with the lender just as they would for a new loan, but it's exactly the kind of detail that a lot of buyers never think to ask about, simply because assumable mortgages were largely irrelevant during the years when rates were low across the board, and there was no advantage to hunting for one. Which is that the rate itself is only one piece of what actually determines whether a home is affordable for you. Property taxes, homeowner's insurance, and if your down payment is below 20%, private mortgage insurance, all get layered on top of your principal and interest payment to create what lenders call your total housing payment. In some markets, particularly ones where home insurance premiums have climbed sharply due to increased weather-related risk, that additional layer can add several $100s a month on top of the mortgage payment itself. And it's easy to focus so intensely on the interest rate that this second, quieter cost gets overlooked until it shows up on your first monthly statement. So where does that leave someone who's genuinely trying to buy a home in this environment, watching rates shift week to week without a clear signal of exactly where they're headed next? The first realistic shift in thinking is letting go of the idea that there's a single correct week to buy. Mortgage professionals who've watched rate cycles for decades will tell you that trying to perfectly time the bond market is a losing game, even for people who do it professionally. What actually matters is whether the payment at today's rate fits comfortably within your budget, with enough room left over for savings, emergencies, and the ordinary cost of living, not whether you manage to catch the exact bottom of a rate cycle that nobody can predict in advance. The second shift is understanding that a rate lock is a tool, not a guess. Once you're seriously shopping for a home, most lenders allow you to lock in a specific rate for a set window, often somewhere between 30 and 60 days, which protects you from increases during that period while your loan moves through underwriting. Some lenders also offer what's sometimes called a float-down option, which allows you to capture a lower rate if the market improves before closing, usually for an additional fee. Understanding these tools transforms the process from something that feels like blind luck into something you actually have some control over, even inside a market that's genuinely volatile. The third shift, and maybe the most important one, is recognizing that your own financial profile has more influence over your specific rate than the daily headlines do. The national average you see quoted in a news story is exactly that, an average. Your actual offered rate depends heavily on your credit score, your debt-to-income ratio, meaning how much of your monthly income already goes toward existing debt payments before the new mortgage is even added, your down payment size, and the type of loan you're pursuing. Two buyers shopping in the exact same week in the exact same city can receive noticeably different rate offers based entirely on their individual financial picture. That means a meaningful amount of your control in this environment isn't about predicting the Federal Reserve or the bond market. It's about strengthening the parts of your application you actually have influence over, paying down revolving debt before you apply, correcting errors on your credit report, and shopping your rate across multiple lenders rather than accepting the first offer, since rate quotes for the same borrower can genuinely vary from one lender to another by a meaningful margin. Something as specific as moving your credit score from the high 600s into the mid 700s can shift the rate you're offered by a noticeable fraction of a point, which circles right back to that earlier math about how much a fraction of a point actually costs over the life of a loan. In a market where nobody can control the bond yield or the next Fed meeting, that's one of the few levers that's entirely within a buyer's own hands, and it's often the one that gets the least attention compared to how much people fixate on guessing the next headline. Let's bring this back to that homeowner in Ohio, watching her locked-in rate get replaced by a different number just 2 days later. The honest answer to her situation, and to anyone watching this wondering whether they made the right call or should keep waiting, is that there was never a perfect moment sitting out there waiting to be found. Rates will keep moving because they're tied to a global bond market reacting to inflation data, oil prices, geopolitical developments, and Federal Reserve signals that shift from one month to the next. Nobody, including the professionals paid to forecast this exact thing, can promise you the bottom. What you can control is whether the home fits your life, whether the payment fits your budget with room to breathe, and whether you understand the tools like rate locks and refinancing thresholds that let you adapt if conditions do improve down the road. That's really the shift in thinking this entire story has been building toward. The headline that rates just changed again isn't really news in the way it's usually presented. Rates changing is the normal, permanent state of this market, not a temporary disruption waiting to settle down into stillness. The buyers who navigate this environment successfully aren't the ones who guess correctly. They're the ones who stop trying to guess, focus on what a payment actually means for their own monthly budget, and understand that a mortgage rate, unlike a home price in a competitive bidding war, is one of the only major parts of this entire process. You may genuinely get a second chance at improving later. If you're in the middle of this decision right now, I'd love to hear where you land. Drop a comment and tell me whether you're buying, waiting, or already thinking about a refinance once things shift. If this helped make sense of what's actually driving these headlines, hit that like button, subscribe if you haven't yet, and turn on notifications so you don't miss what's coming next. Because the rate on your mortgage might change again next week. What you do with the understanding of why it moves is the part that's actually up to you.